A pause it is. Policy rate kept unchanged at 5.5%. GDP growth projection unchanged for this year despite tariffs. I think that's fairly important as well because that shows strength as well as confidence in what India is going to do. Right now it's all talk, right? There's no tariff rate which is up there as well. The stance has been unchanged, remains neutral, so no letting go there or turning to accommodative. RBI is going to stay vigilant on tariffs. That's expected for him to say. CPI inflation. So the number for this financial year has come down fair bit to 3.1%, but that would have been expected because of what we saw in the first quarter. However, Governor does say that by Q4, you are going to see CPI inflation inch up above 4%. Core inflation, meanwhile, will remain above 4%. So those are some of the important factors coming in. But Hiral, he is very clearly giving a message that India is not going to start quickly changing things. We're a steady ship and we'll wait and see what comes on tariffs, etc.
And with that, two other aspects what I took over here is in terms of takeaways, the growth risks. Because what he said is that the growth outlook probably remains vulnerable from here on, and this is to global uncertainties and the external headwinds. So that is something which we need to keep an eye on. And secondly, if you talk from a consumption trend perspective in the domestic market, your rural consumption is what he's describing pretty robust. So that is one of the positives. And secondly, the recovery that is coming in urban demand, that will be sustained. These were two things that he spoke about as well in his commentary. So if there is a transmission in terms of urban, that is going to be the key, because rural, every corporate is talking about the strength over there.
Yeah.
Urban turnaround is not yet seen.
But they're talking about it coming.
Exactly.
They're talking about it happening. So maybe you're going to see some of that.
So something on that end is going to be very crucial to watch out for from a growth perspective now.
I think also clarity that 100 basis points have been cut since February this year, and that transmission is still on. In fact, let's get to our first takes from Sakshi Gupta, who's joining us now. She's Principal Economist at HDFC Bank. Ms. Gupta, thank you so much for speaking with us. Just your take on the policy. I think a pause is what was widely expected as well, but it's clear that our gunpowder is being kept dry for when it's required.
Well, I think that as you rightly said, the, policy rate decision today was widely expected. Look, I think that we need to see this in the context of the fact that the RBI has already delivered 100 basis point rate cut so far in the calendar year 2025. I think that they signal that, look, we are, looking at what is happening on the growth front, but also looking at, the inflation trajectory where currently, while inflation numbers are coming down, I think that from 2026 onwards, inflation will also start, naturally picking up because there will be an unfavorable base effect. So if you look at where RBI is projecting Q1 FY27 inflation, that is close to 4.9%, right? So I think that they are in a wait and watch mode. They are looking at how some of the monetary policy easing that has already been delivered, how that kind of transmits into the system. The macro data is still very, very mixed. We are seeing positive signals from the rural side, while in other sectors, for instance, in mining, etc., or the IIP data has been weak. I think that, the argument that, the RBI needs to cut further, especially because of what is happening on the tariff front. The tariff news, as we all know, is still very, very uncertain, right? So, at the end of this month, there will be further talks that will happen between India and the US. And, it is still very uncertain whether we will remain at 25%, whether we go higher from here, or there is a possibility that India could eventually end up with lower tariffs, similar to what some of our peers are, currently imposed with. So I think it is still an evolving situation, and therefore the impact on growth, etc., is still very uncertain.
Okay, stay on with us, Sakshi. Maneesh Dangi also joining us in conversation. He is founder of Mosaic Investing and Research. Devang, Shah, head Fixed Income Access Mutual Fund with us, as is Jaideep, Iyer, head of strategy RBL Bank. So we're getting views all around. I'm going to come to you first, Maneesh, on what you made. We're steadying the ship. There was some spike of expectation that there would be a rate cut of 25 basis points. That's clearly not happened. Street has not got that little booster dose maybe it needed, and you're seeing that reaction pair out. But all in all, a message that we're going to have a sensible monetary policy which sticks to what we have already put in place.
You can't call RBI's policy nonsensible, unsensible, so to say, ever. On TV.
Yeah, yeah.
So it's okay. I mean, we just had sort of lots of rate easing, liquidity easing in last few months. I think, Indian conditions would drive rates a lot lower. That's been my view on your show for many, many quarters. I think both exteriors and interiors of economy actually are not supporting a case of a pause at this stage. But having done a very largish 100-odd basis point rate cut, as you said, since February, could you watch for a quarter? Yes, of course, especially with respect to the uncertainty around us. I think, to take a step back, I think India leverage cycle is clearly thawing. The corporate leverage cycle could not get cranked up in last 2-3 years of having such substantial high margins across corporate, and the household leverage cycle has slowed, and so to that extent, at some point in time, if you want to crank up the growth, you will have to sort of ease monetary policy, given the space in the fiscal side is very, very limited, Tamanna. So my view remains that we are transitioning, and I've made this fundamental point, just last point here, that India is transitioning from a sort of middling 6% inflation to 2 to 4% inflation over the next many years. And that would mean that the rates will have to settle a lot lower than, what we've seen in last 5-10 years. And it would happen slowly and steadily, but, there is that what we saw in early 2000s, a second set of transition is happening as we speak, as economy evolves from a...
Maneesh, I just know, just to the point that you made, and I want to contextualize that. I think it's important because my point is that a non-reactive policy, when I say sensible, and I think that's important to put into context and on record, we're not a nation and not a central bank that reacts to daily threats and hyperbole that we're seeing around us. So it's important that we are measured, we are steady, and we don't change our track because of one of the largest economies in the world threatening us with very high tariffs in the next 24 hours, and we don't know what's going to happen there. So just to make that point, I think Vishwanath wants to come in with a point and a question.
Right. So one of the points, Tamanna, that the governor did make was about the way that credit growth is panning out. Yes, bank credit growth has not grown that fast. However, general flow of credit to the economy and to specifically corporates through the bond markets, through other borrowing avenues, has improved. So that's why I want to ask a question to Devang Shah. We've seen some amount of reaction on the bond yield side, but overall, if the governor is happy with the way that the flow of resources is happening into the market currently, what does that say about the future course of the bond yields? I mean, the benchmark is an indicator, but overall around corporate bond yields as well.
Yeah, so first of all, I largely agree with the other panelist. First, RBI has done a very, very good job in the last 4 months about front loading all the liquidity, 12 lakh crores of liquidity injections. Secondly, they've also done 100 basis of rate cuts. Can there be more? Yes, definitely, because we are having a significantly lower cycle on inflation. Now, specifically coming to bond markets, I think what all of us need to understand is that we are nearing the fag end of the rate cut cycle. Now, probably, yes, we have 50 basis or 25 basis of rate cut more. Yes, but are we moving to a 4% repo rate? Our view is no. Probably we'll pause between 5 to 5 quarter in this cycle. Now, with that context, the demand supply dynamics for bond markets, and incrementally when I'm looking across at gross SDL issuances, gross government borrowing, I think next year onwards, the fiscal consolidation also stops. So incrementally from here on, government has done a very, very good job. They've got from COVID era from 9% to 4.4%, and probably we might see a 4.25. But incrementally, massive fiscal consolidation from here on looks limited. In that case, where supply on government bonds and state development loans continues to remain higher, we don't see too much of rally in bond markets. Now, when you also alluded on the point on corporate bond and the short end of the curve. I think liquidity in the system continues to remain positive at least for the next 12 months. And RBI is proactive. RBI wants to transmit rates. In fact, I think as both the panelists spoke about, they want growth to be supported, and they should support because fiscal support is limited. With that context, liquidity remaining positive, the short end of the curve will continue to remain well behaved. Our view is that corporate bonds can trade lower, and the short end of the curve, which is 2 to 5 year segment, can remain positive. We are not bearish on policy, but our assessment is that fag end of the rate cut cycle, and in a market where demand supply dynamics for government bonds might not be so positive incrementally, the long bonds will remain where they are. Short end or the short bond segment will continue to be the favorable segment for investors.
That's an interesting point between the long-term and the short-term bond deal cycle from here on. But let me get in Jaideep Iyer, Head of Strategy at RBL Bank as well. Jaideep, good morning. How are you reading the announcement? Because the stance has been maintained and a status quo in terms of rates as well. This does get in some bit of uncertainty in terms of what the RBI could do next when you talk about October and December and its impact from a treasury perspective.
Yes, I would, largely agree with the discussion so far. I guess it was, from a governance standpoint, obviously you need to keep something in your pocket. You can't, and I think the last rate cut was clearly front-loaded, and we haven't yet seen all of that transmit to credit markets and deposit markets, and it typically takes time. In fact, in my judgment, a 25 basis points cut today would have not made much of a difference. In fact, it would have been negative for the banking sector because asset prices will come down. Credit asset for loans would come down, but deposits will take time. So banks would not transmit significantly to incremental lending. And that's what we've seen over the last few months. And therefore, there is time before that transmission happens. And I think it was the right decision. Clearly, there is abundant liquidity, and I think while the stance is neutral, it was amply clarified that liquidity will be abundant. So all in all, I think very much on expected lines.
Maneesh, one of the statements or one of the points of the governor where the GDP projection has been kept at 6.5% for the year. Just wanted your take on that, because one way or the other, there is going to be some tariff impact. And that tariff impact, do you think, is a revision that we'll see perhaps in the next policy when the dust clears?
I agree, Tamanna, but there is a lot of uncertainty, and it is possible that we sort of retrieve the situation over the next few weeks. Impact of that in the first order will be 20-30 basis point only. I think the larger impact is through sentiments, and just in case if all of this leads to further slowdown in otherwise a very, very slowish capex growth. So I think to that extent, at this point in time, there are fat tails on both sides, and it's best to sort of, if you look at the distribution of growth outcome, I would say the uncertainty has risen quite substantially over the last 3-4 months, but the central tendency could still very well be the same that you could have argued, 3-6 months ago. So I think it's prudent to sort of keep it at that. It is an evolving situation, Tamanna, and my sense is that my fear is that the likely outcome would be the lower growth, but it's not so evident that it could be put out by RBI right now at this stage.
I once wanted to take a question with Sakshi Gupta of HDFC Bank. Sakshi, I just wanted to get your sense about this inflation projection cut that the RBI has made. FY26 inflation, CPI inflation projected now at 3.1% versus a 3.7% earlier. But then Q1 FY27 is sharply higher at 4.9%. I just wanted to get your sense as to what this could indicate about future monetary policy decisions. Could this be reason enough to then lower rates in case the changes on growth happen, as Maneesh was pointing out?
Well, look, let's look at, why the RBI has downwardly revised their inflation forecast from 3.7 to 3.1. And I think this was broadly expected. Our forecast for inflation for this year is an average of 2.8. Right. The recent inflation prints that have come out, and even for July, we are estimating that inflation could be closer to 1.4. Brings down the inflation trajectory for at least, the coming months in 2025. Now, what starts happening from the next year is that because of a very low base effect, naturally, the headline YOY inflation prints will start inching up. So the 4.9% forecast that RBI has for Q1 of next fiscal year, it is broadly taking into account the fact that there is an unfavorable base effect. Now, what is the implication of that for monetary policy? Look, I think that the governor has made it very clear in a number of communications, both in the last, June policy meeting, as well as his recent, interviews in July, that perhaps the move on the interest rate front in terms of rate cut next would be primarily governed by what happens to the growth, situation. So my view is that, look, de facto, yes, they do have space to cut by another 25 basis points. They had that space even in this policy. But clearly, they are waiting to see whether there is any meaningful downside risk on the growth front compared to their 6.5% GDP growth forecast. And as we were earlier, discussing, tariff is just one part of the story, right? So most estimates suggest that there will be, between 20 to 30 basis point drag on GDP growth. But at the same time, you have a rural economy that is doing much better. You have monsoons that are, performing better. You have, the construction segment, etc., and other capital goods, segments that are performing better than the rest of the economy. Moreover, even in the tariff context, I just want to make a point that we have to look at rupee's performance from here on, right? So in relative terms, if the rupee continues to depreciate vis-a-vis a lot of the Asian peers, that could kind of mitigate or at least partly offset the tariff differential at 25% that we currently have. So there are just too many moving parts at this stage. And I think the next 3 months would be important to judge what happens to growth. If there is a clear downside, risk to growth in the next 3 months, then it opens up space for policy rate cut. Otherwise, I would expect that this is perhaps the end of, the rate cut cycle from the RBI.
Interesting, end of the rate cut cycle from the RBI. That could be a possibility. Manish, let me come to you to put this into context from a markets perspective as well, because one, you're already talking about inflation and growth and the way RBI is taking that flexibility to act in the future with their stance kept at neutral. But if you look at the market and investor sentiment seems to be negative. We have markets which are at the day's low as well. If you have to tie this up to the way the earnings have panned out in the first quarter and what happens from a valuation perspective, what does this take you to at this point in time?
So, the biggest variable that markets have to incorporate in their, and analyst modeling have to incorporate in their model is that India's nominal GDP growth is no more 11, 12, 13%. It's likely that it's in 8-9% range. And remember, I'm talking of nominal GDP growth. If you actually survey street, and incidentally, I did speak to sort of many people simply asking this simple question that over next 2-3 years, what is the expected nominal GDP growth? And sort of an average number did turn out to be close to 11 or 12%. So I think there could be a substantial revision at that level, that it could very well be sub 10%. And that is what drives revenue growth. That is what eventually also drives profit growth. So my sense is that, markets have to incorporate this new sort of reality. Now, how do you contextualize policy vis-a-vis that? So I understand the growth inflation dynamic, but markets have certainly not incorporated an 8-9% nominal GDP growth. And you cannot sort of contextualize a 21 times forward earning with 8-9% of nominal GDP and therefore 6-7% of revenue growth. So to that extent, if the markets had to be priced appropriately, either the policy rates had to be a lot lower, or market had to be a lot lower to sort of ensure that they're in equilibrium, so to say. So that's how I would think. India has transitioned, as I said, from relatively moderate inflation of 4-6% to lower. And RBI is also talking about 3% inflation over 12 months. My sense is that that's not yet there in the rates. Rates are still the same that they've been in last 10 years, and they need to go sort of a lot lower from where they are right now.
And nevertheless, the response has been fairly negative as far as the markets are concerned to the policy. I mean, look at the Nifty reality. Let's pull up the intraday for the Nifty reality and look at the nosedive that it has taken. The advanced decline has also worsened substantially. The small cap 250 is not looking like it's in a good place. Nifty IT was anyway, IT stocks were quite, poor performers since this morning. That's only worsened going further. So clearly some concerns on demand also coming in, even though rural demand is looking robust, etc. But that's not what the big driver is, for example, for some of those real estate stocks. Maneesh, why do you think this kind of reaction really from markets? Is it more about uncertainty about what's happening with tariffs and what is seeming like a rift growing between India and the United States?
Tamanna, the biggest contest, just to contextualize, biggest contest post 2020 in the world across countries was that who gets the inflation right. And India somehow, relative to any Western country, got the inflation right, and that was rewarded by the market. I think the biggest contest across countries who gets the growth right. And it's not very clear to me and to many analysts, and more importantly to markets, that India would get this right. I think conditions are a lot more difficult than what is made out to be in a public discourse. And so to that extent, markets are generally nervous. Of course, Trump is not helping. It's making us a lot more nervous. So to that extent, we've argued about this for the last 6-12 months. These listless times are representative of this nervousness that, where is growth? Are we going back to a pre-COVID sort of a lowish growth regime? Or what we saw post-COVID, that, this little bit of a euphoria that we've entered in this new regime where, India can sustain at higher growth rates. There is a little bit of a review happening to that view that was formed after COVID for last 1.5 years. And that is what you see. Policy as such could not be reasoned why, real estate is down today. As a matter of fact, real estate sales across top 8 cities have nosedived, Tamanna. And so that sort of tells you that the consumer needs some more support. Rates have come off, but they need to perhaps go down a lot more, or in some other way, if you could actually stimulate the economy. Otherwise, the inertia in the economy is that it will slow further from where it is right now.
I want to ask a question to Jaideep Iyer at RBI Bank. One would probably look at the RBI governor's commentary and say that he doesn't really have that much to give to banks anymore. I mean, we've passed on 100 basis points. We've given you 100 basis points of a rate cut. Now you have to pass it on to the broader economy. I think 70 basis points is what the number that he said that which had happened on the new rupee loans. Existing rupee loans, of course, that movement is slower, and it typically is. But at what point do you think that transmission cycle ends? At what point does that then growth fillip happen because of the lower interest rates on the lending? Because again, on the deposits as well, the movement has been relatively slower.
No, so I think there are two parts here. One is, I think, on the transmission, I guess clearly banks would want deposit transmission to happen in line or maybe even ahead. And it's hard to kind of, if you look at term deposit interest rates, they're already down to 6.5, 6.6%. So I don't think, there's much left there. So I would say another couple of months, 2 to 3 months will be required for some more transmission, but that's about it. The other factor for credit growth is also underlying demand. I think we've seen a fairly challenging time on unsecured lending. There are cropping issues on low ticket secured lending coming up slowly. So banks will be cautious, and banks will want to protect margins. Banks will want to protect risk. And therefore, I would say that monetary policy has done its bit, I would not really expect anything materially more from monetary policy here onwards. In fact, even the risk weights had come down in a few sectors. NBFC risk weights came down, microfinance risk weights came down. So there's nothing much honestly left, and I think we need the fiscal to kind of now start showing through, because we've seen fiscal consolidation for a while, and from here on we should get some support from there for underlying demand to come.
I just want to take forward the point that Maneesh made, and I'm actually going to ask Sakshi that question, if that's all right, on whether there is an uncertainty on India's economic growth that is not as visible right now. There is concern on the horizon, and perhaps that's what the street is picking up.
Right. I mean, I partly agree with what you're saying. Look, the India growth story at the moment is very, very mixed, right? So there are segments, particularly when we look at urban consumer demand, where things are not that optimistic, and they've been actually slowing down over the last couple of quarters. So this is not very recent. I mean, that has happened because, inflation was very high. You had, fairly moderate nominal GDP, nominal wage growth. Coupled with that, I think hiring intentions in, a number of pockets in the economy haven't really been very, very optimistic, right? So we have seen, headline numbers in terms of, IT companies, for instance, talking about slowing down their, hiring plans. So yes, of course, there are segments of the economy where things are much softer or weaker than what the headline number might be showing us. And honestly, that's been the India story over the last 2 or 3 years, where there's been very, very mixed trends, particularly on the consumption side, where earlier you saw urban was doing better compared to rural, and now that story is kind of flipping around. I think one point related to growth and the earlier discussion that we were doing was that, look, RBI's decision today to keep the policy rate unchanged also needs to be seen in the context of the fact that there are limitations to what monetary policy can do in terms of ramping up growth. Right. So I think there needs to be also, we have to wait and watch for how the fiscal spending patterns this year pan out. There's been a lot of front loading, how that kind of filters into the system. And there's been some talk of, further government support, perhaps for certain export-oriented sectors, if there are pockets of stress because of these, the current tariffs. So those are some elements, I think, that now become more critical than monetary policy action in terms of assessing what happens to, the GDP growth out.
Okay, so that's, what we're looking at so far in terms of the assessment. Very quickly, one question I have, Maneesh, with you is, taking into consideration the festive season is just about to start, a couple of comments that we heard from the governor as well in terms of how urban is just about to pick up, rural is strong, and inflation trajectory is also pretty okay. What are the sectors you would advise investors to then bet on taking the valuation angle and your FY26 earnings trajectory?
So, two parts to it. One, of course, I think that the inflation is generally the best indicator of growth. And so to that extent, if it's so low, one must ask as to what is wrong with the growth. Low inflation in India is not, such low inflation in India is not a thing to rejoice. There is some disinflation, which is somewhat more malignant than what you would desire, is in play. Two is that, I think bank balance sheet is the place where you should look for whether there is a growth perking up, because, that they will drive the leverage cycle, which perhaps will take us out from a little bit of a growth pangs that we are going through. For investors, I think, I've argued that, these are listless times. I don't think there is a lot of risk premium in equities. Bonds, you had sort of a great time, good 1.5 years where you could, I argued on your show many times that, bonds most likely will outdeliver equities. The odds are not so much in favor because valuations are expensive. But, at margin, even today, I would say that, these poor 635, 640 yielding bonds would actually end up delivering better than equity over next 1 year. So stay sort of somewhat overweight bonds. As some argue the AAA bonds actually deliver a little bit more. And so sort of look around for opportunity within the bond space. These are times to actually preserve cash, preserve your capital. Good times will come again, and likely, you'll get an opportunity in next 1.5 year to dial up risk again.
Okay. Thank you so much, Maneesh. Thank you so much, Sakshi, Gupta, and Devang, Shah, of course, for joining in. Jaideep, Iyer, thank you to all of you.